Our next guests are the Smarter San Diego Reverse Mortgage Specialist team, the Harmes team, Scott and Christina.Harmes. Welcome to the show, guys.
Morning, Derek.
Morning,
Hey,
thank you.
Great to have you. Now, there's a really important thing going on right now in the world of retirement funding, okay? And a lot of people have underfunded retirement accounts. In other words, they don't have enough money saved for retirement. The reverse mortgage is something that could potentially be the solution for that, right, Scott?
Really true, Derek. As a lot of our clients are turning 62, they found that their pensions, IRAs, 401ks, plus Social Security are not quite enough to get them to a comfortable retirement lifestyle.
Right.
Most financial planners say that Social Security will make up about 40% of the average wage earner's post-retirement income.
40%.
40%.
Okay.
They're going to need about 70% of their pre-retirement income in order to retire comfortably.
Okay.
So the average wage earner is going to have about a 30% shortfall. So they're going to be looking to their other investments, their IRAs, 401ks, pensions, to make up that difference. One of the assets that a lot of homeowners haven't looked at is the equity in their home,
right,
to help make up that shortfall. And that's what a reverse mortgage can do.
Which is really interesting because I think originally, we go way back to when people were buying houses for the first time, when you could first own your own property and you got a loan from the bank and you went and you bought a house and you made payments and eventually you owned the thing free and clear. And that was a good portion of your retirement. In fact, that's the number one thing I recommend people do. If you don't do anything else, make sure you own your home free and clear, because then you'll be okay. Then you'll have options like a reverse mortgage to come in if you didn't save enough money otherwise. But once you get to that point where you've got a house that's paid off, a lot of people think, well, I got to keep the house paid off, right? That was the thing. I need to keep it paid off, otherwise I'll have to make a payment to somebody. But that's not how a reverse mortgage works, is it?
Not at all. In fact, the reverse mortgage was created in 1988 by an act of Congress, signed into law by President Reagan, really to make up for the shortfall from Social Security. Because when Social Security was enacted in 1935, the average life expectancy was 58 years old.
58?
58.
Okay, and Social Security doesn't kick in until 62.
Correct.
So the original idea behind Social Security was, in case you outkick the coverage and outlive the life expectancy, we've got some money here for you, because you probably won't be able to work at that point in time.
That's exactly right.
You got people working until their 70s, 80s now? No
Well,
problem.
that's exactly right. I mean, my life expectancy for my age is 83. So I better have at least 21 years 21 years cushion built up. Now, Social Security is somewhat flexible in that you can take it at 62, at 66, or you have to take it at 70. Okay. But full retirement age is 66. At your full retirement age, you get to take 100% of your benefits.
Okay.
But you can take them early at 62, but you pay a penalty for that. For each year prior to full retirement age, you take your benefits, there's a 6% reduction in benefits. So if you take your benefits at 62, you're taking a 24% deduction.
And that's permanent, right?
Permanent, long term. But now if you can actually wait till you're 70, 4 years after full retirement age, for each year you wait, your benefits increase by 8%.
That's huge.
So that's a 32% increase in what your permanent Social Security benefits will be. So what we find is a lot of our clients that have, say, 40% or more equity in their home can use a reverse mortgage to supplement their monthly income to delay taking Social Security.
I see.
And if they wait from the time they're 62 till they're 70, that is a 54% increase in what their Social Security benefits will be.
That's so big. It's huge. Now you say getting paid through the reverse mortgage, so I'm going to get Christina involved here. Tell us about some of these options, because how do you get paid from a reverse mortgage?
Well, it's really the equity in your home. So it's proceeds, and it's equity that you've already paid into your home. So you can get it immediately as a lump sum. You can get the money right now. And a lot of our clients do that maybe if they want to pay off a car, pay off some credit, minimize some of that outgoing cash every month. The first way that a reverse mortgage is always used is to pay off your current mortgage if you have one. People with a small mortgage pay that off first. Then they have options to use the money in various ways, maybe to get a little extra income every month. You can do that like we talked about for delaying Social Security.
So I don't have to take all the money at once then. Basically I can, if I want to get a reverse mortgage, should say I have to pay off my mortgages first, whichever mortgage I have, if I have one.
If you have one,
I have to pay those off first. But then what's left over, I can take every month instead of taking it all at once?
Absolutely. And we can kind of do a mix and match, whatever is really right for you. Say you want to buy a new car. So you take maybe $30,000, get that new car now, but then you do want the additional income. So every month you're going to maybe receive $1,000 and you're not going to have a mortgage payment anymore. So that really increases your cash flow and you already got some of the upfront money.
So let me ask you this then. So if I have, let's say, $100,000 available that I could take out all at once, but I choose to get it every month. Am I going to get it for 100 months then? Because I'm going to get $1,000 a month for 100 months, and then it's over. Is that how it works?
Well, it's really going to depend on your age at the time we're looking at it, and how much equity you have, and what your goals are. So that's going to come up with a formula. If you're going to take a 10-year payment, which is an equal monthly payment for as long as you live in the home, then that's going to be one thing. If you want to delay Social Security and you're telling me, I'm 62 now and I want to wait till I'm 70 to take Social Security, so figure out how much monthly you can give me. We can do a term for 8 years and I can give you this much monthly just for 8 years and then stop it once you want to take Social Security.
Wow.
One of the benefits of that is that then Social Security is no longer tied to if you live in the home.
That's huge.
Reverse mortgage, you do have to live in the home to get these monthly payments. So.
Right.
It's a really smart strategy overall.
So it sounds like it's very flexible then as far as what's possible, based around the needs of the individual and how they're trying to structure funding their retirement.
Really flexible, and you can change your mind over time in that you could start by saying, I want a 10-year payment. And again, that's T-E-N-U-R-E, 10-year payment.
Not a 10-year payment.
Not a 10-year payment. And that's, again, as Christina said, calculated on your age and equity in the home. And you could be taking that payment, say it calculated out to $1,300 a month for the first 8 years, from 62 to 70. Then when Social Security kicks in, you could quit taking that altogether, and whatever the available balance is on your reverse mortgage, that balance grows by the note rate. So each year you don't take additional money on the reverse mortgage, the balance available to you gets bigger.
Interesting.
And
so that's huge, because there are a lot of people who might say, you know what, I think I have enough. I think we've got enough saved up here. But who knows? I mean, a lot of people are living to be 100 plus years old, right? So if you have the opportunity to put aside something, even if you're not taking money out right now, but if you have the opportunity to get one of these credit lines established so that you can have it grow and have something there just in case, and it doesn't really cost you anything to have it accrue over time, right?
It doesn't. In fact, the credit line is going to grow, and the credit line will grow faster than what the money would be available to you if you just waited to be older, because the amount you can get is calculated on your age, but it grows faster as a credit line than it does because of your age at point of entry. Okay?
Gotcha.
And this credit line is great for what's called a standby reverse mortgage, and this is used a lot by financial planners, in that for borrowers that don't really feel like they actually need it, they get the standby reverse mortgage, which the available balance to them gets bigger every year, and then they do portfolio management with it. In down years in the market, instead of pulling money out of the market, they pull money against their reverse mortgage credit line. In up years, they actually are pulling money from their investment portfolio and paying down the reverse mortgage.
That is absolutely brilliant.
It can triple the life of an investment portfolio for a retiree. And one of the things we have found is that many retirees fear running out of money more than they fear dying.
Yeah. Well, this is an amazing opportunity for people who are 62 years or older if you own your own home. Scott and Christina, thank you so much for being here today and explaining to us the reverse mortgage details.
Thank you.
If it's the case that you have questions about reverse mortgages, call Scott and Christina.Harmes. They will shoot you straight. They'll tell you what you can do to potentially save an underfunded retirement or just live more comfortably in your golden years. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else.